Today, June 4th, is another rate decision from the Bank of Canada. And no surprise here, they held steady at 2.75%. Now, markets were only giving a 22% chance of a cut after the stronger than expected GDP report, so this was pretty much priced in. But here is the bigger picture. This summer still looks like a turning point. A year ago, the bank's policy rate was at 5%. Today, we're sitting at 2.75%, and that's nearly a 50% drop, and we are not done yet. Most of the big banks now expect 2 more cuts before year end. June might have skipped, but July's cut odds are pretty high still. Quick pause, if you are new here, we are a real estate sales team here that helps investors buy smart, value-add multiplexes in the city of Toronto. We work with first-time buyers, experienced landlords, and even builders, and we share exactly what is working right now. If you like this kind of data-driven market breakdown, hit that like button, subscribe, and book a free strategy call with us if you want help building your portfolio right away. All right, let's get right into the data. Canada's GDP grew more than expected in Q1, mostly from export growth ahead of US tariffs, stronger business investment, and gains in oil and mining. But the surface strength is hiding real cracks. Household spending is slowing. Residential investment and resale real estate activity saw its biggest drop since early 2022. And the Bank of Canada knows this, and they already said Q2 is expected to slow down more. So while they didn't cut in June, we are still on a clear path to looser policy. Now, on the inflation side, headline numbers are falling. Core inflation, though, which excludes energy, rose and is still sticky, but holding still between 2 to 3% right in the target zone. Not perfect, not scary either, so nothing here is actually stopping the Bank of Canada from cutting rates more. So what does this all mean for real estate investors in Toronto? Well, we are in a strong buyer's market. Lots of listings, demand has fallen, and so there is a lot of negotiation power for the buy side. Toronto prices have already dropped over 20% from the peak, and even though some people are still holding out for a 1990s style crash, hoping prices will fall a full 30%, based on what we've seen, we're probably actually at or closer to the bottom than you think. And here's why. Number 1, supply is way tighter today. Back in the 90s, we had way more homes and fewer buyers. Today, we've got a full-blown housing crisis here in core Toronto. You have to knock down a house just to build another one, and this is actually why the city is pushing hard for more multiplexes here in Toronto, allowing us to turn single-family homes into fourplexes and even adding backyard houses. And starting as early as mid-June, the city of Toronto could take that even further, allowing 6plexes as of right. So the message is clear. We need more housing, and it's not coming fast enough. Number 2, sellers aren't actually in as much trouble as you think. Most homeowners aren't being forced to sell. Mortgage rates are sitting at around 4%, not that low, but still pretty manageable. Plus, banks are working with borrowers to avoid power of sale situations, so we're not actually seeing those distressed sales as much flood the market. Number 3, inflation just supports home prices. Labor and material costs are still very expensive, which really just does keep build costs high, and that will put a floor on home prices, even on the resale side. And number 4, the correction has probably already happened. The 20% drop that we've already seen, well, that was the market pulling back from the froth from 2021 to 2022. Condos are obviously still very weak today, but there is real demand on the Toronto freehold front from end users, and prices have already stabilized for almost 2 years, especially where fundamentals are strong. And number 5, this time rate cuts are coming. In the 90s, interest rates were stuck in the double digits. Today, we've already hit the peak, and we are on our way down in the lower single digits. With 2 more rate cuts expected by the end of this year, that's going to continue to improve affordability and buyer confidence. Number 6, the tariff situation, the unknowns there look like it is starting to settle. Yes, there obviously is economic uncertainty still, but the tariff front is showing signs of resolution here. So, Could prices dip a little bit more? Yeah, of course. But to get to that 30% drop, we would need a major recession, massive job losses, political and policy shocks, and runaway inflation again. And none of these are showing up right now. The data points to more stability, not panic. And the best part, deals are finally starting to make sense again in the Toronto real estate market. We're seeing fully turnkey 2-unit homes selling under $800,000, cash flowing over $700 positive per month on day one. That same house in 2022, you would be lucky to break even when rates were slightly lower back then. So, if you are waiting for the headlines to tell you that it is the right time to buy, you're probably going to be already behind by then. By the time the news says that the market is recovering, it's probably been recovering for months and prices have already bounced back. That also means more competition, bidding wars, and way fewer deals. The real opportunity is when things don't feel perfect yet, but the numbers make a lot of sense. Huge cash flows, potential to improve more, and stable prices. So if you do want to learn more about how multiplex deals look like today in the Toronto market, let's chat. We're a Toronto real estate sales team that works with investors every single day. Whether you're looking for a simple cash flowing multiplex on day one or a bigger value add project, we can help you spot the right opportunities, run the numbers, and guide you from offer to tenants. Just book a free strategy call with us and let's build your plan.